morning from frosty Chicago, where it is a nippy 4 degrees below zero. My son Jack and I will be jumping into Lake Michigan this upcoming Saturday to raise money for some Chicago families that are in desperate need of some financial help. So we're crossing our fingers and hoping for a warming trend this week. I'm John Kosar, Chief Market Strategist at Asbury Research. Thanks for viewing our latest Following the Money podcast. Today's date is Sunday, January 19th, 2024. Asbury Research is a registered investment advisor and has been providing both investment research and asset management to individuals and professional money managers since 2005. So this makes our 20th year in business, and boy, it really went by fast. We are now also investing via our Asbury Research models and model portfolios for professional money managers, including RIAs, as a third-party money manager. You could learn more about our 4 model portfolios right here under Asset Management, including hypothetical back-tested performance for each of those model portfolios. In today's podcast, we're going to be taking an updated look at 2 of our models, the Asbury 6 and the CEIF model. We're also going to give you a free look at our latest, the weekly wrap-up report, and which is one of the many reports that are available to our premium subscribers via Asbury Research. So let's begin. The Asbury 6 is right here. This is actually located behind the paywall, so you need to be a subscriber to the Asbury Research Premium service in order to get there, but that's where this is. If you are a subscriber already, you can follow along with us, and if you're not, follow along on the screen and we'll give you an idea of how this model works, what its origin is, and what its purpose is. So the Asbury 6 is a daily data-driven gauge of the U.S. stock market's real internal health, according to 6 diverse market metrics, which we selected via quantitative backtesting. Every one of these indicators, though, all indicators have an Achilles heel. Doesn't matter what it is, there are some indicators that just do not perform well during certain market conditions. So what we did, and this was really a direct result of the much greater day-to-day volatility that we see in the market now that really wasn't here 10 years ago. The origin of this market goes back about, or of the Asbury 6, the origin of the model goes back about a decade, and we built it initially because it was very difficult to determine what the character of the market is, what the condition of the market is, by looking at the S&P 500. As more and more computerized trading kind of came to the fore, you saw a lot more choppiness in the day-to-day activity of the S&P 500. We believe a lot of this is due to algorithmic trading. I think a lot of these algos are built to try to get traders offside. They will push the market underneath a support level for a brief second, scare everybody out of their long positions, and then 3 days later, we're making fresh highs in the S&P 500. I'm sure there's a bunch of heads wagging out there that have experienced this very thing. So what we needed to do was come up with a better way to determine the daily health of the market than chasing the tail of the S&P 500, because that's our job here. Our job, being around, I've been around the markets for 40 plus years now. We needed to not get faked out by a lot of these erratic movements that we see from day to day. So what we did is we took the 25-ish favorite market metrics that I've been using throughout my whole career. Some of them were from the trading floor, where I spent the 80s and most of the 90s, and some of them came after that. But what we did is we started to back test them in sets of 3, sets of 5, try to find 6 or 4 or whatever was going to back test the best. This all has to do with hypothetical back testing to see what actually performed the best. And what we came up was 6 indicators that are really different from one another. We've got the rate of change in the S&P 500, which is the only one that is directly related to the movement of the S&P 500, and we did it on purpose. We've got the relative performance of stocks versus high yield bonds. We've got investor asset flows, volatility, trading volume, and market breadth. So when 4 of the 6 are of one color, green or red, that's a directional bias for the model. Coming into last week, which was Monday the 13th of January, all 6 of these were red. They were all here, indicating the market was internally weak. As of the middle to latter part of last week, everything shifted to positive really quickly. The reason for that was that at a support level that we had identified was tested 3 times in a row, and the market couldn't sustain a breakdown through that level. Stay with us. When we get into the weekly wrap-up, we're going to show you that chart, and we're going to show you exactly what happened. It'll make a lot more sense. But what happened, you can see all these dates, or most of these dates here, were at the middle to latter part of last week. That's when the market jumped higher. Financial TV blamed it on the CPI number. The CPI number was really not spectacular to cause that kind of a rally. What it really was is this chart that we're going to show you in a few minutes, where when the market can't break a support level after multiple attempts, all those shorts get kind of caught leaning too far downward, and all it takes is a little move the other way to scare them all out. And I think there was a lot of short covering that basically took place at the end of last week. So we're 5 of 6 now, heading into Tuesday, because Monday's a holiday, and that indicates that the market is internally strong enough, as long as 4 or more of these stay green, to be able to sustain this rally. If it changes again, we're going to know about it because we're going to see it in the Asbury 6. Here's an idea of how this works. It's very sensitive. This is about a year back. When Asbury 6 is 4 or more green, there's a green arrow here. This is May 3rd, actually, of last year. Let's take a look at the 3 most recent signals. Back in November of last year, November the 6th, the Asbury 6 turned back to 4 or more green, or a positive bias, and that was right down here. So we caught this nice move here up into the middle of December. Then the Asbury 6 turned 4 or more red right here on D16, which is about a week after we peaked on the 6th of December, but pretty close to the top. And now, again, as of this upcoming Tuesday, the 21st of January, we're flipping back to green. We're flipping back to a positive bias for the model. Let's move now to the CEF model. CEF is sector rotation. The CEF model, which is right here, is a completely data-driven sector rotation model. It was created to quantitatively identify long overweight opportunities in U.S. market sectors by following the money as it moves around the 11 sector spider ETFs, which, if you put them all together, it's the S&P 500. And we do this in multiple time frames. We do it in trading, which is a week, tactical, which is a month, and strategic, which is a business quarter. What we did is we developed a algorithm that measures the velocity of money as it moves around those 11 sector spiders, which again is the S&P 500. And the ones with the lowest scores are up top, and those are the best scores. So heading into this brand new week, the money is most aggressively going into financials, energy, and industrials, which are XLF, XLE, and XLI. The money is coming from these bottom 3, which have the highest scores: technology, healthcare, and materials. So if you wanted to ask me to answer you in one sentence, what's going on in the sector space? Well, there's a lot of money in multiple time frames that is moving into financials, energy, and industrials, and that is rotating into those from technology, healthcare, and also materials. According to our hypothetical backtesting, for the CEF model, the CEF has outperformed the S&P 500 by 8.1% on an annualized basis since summer of 2018, with a 13% smaller maximum drawdown, which is really important to us, the drawdowns, and also a lower beta, which means your P&L is going to be a little less jumpy. Moreover, we have significantly outperformed our peers, other ETFs that also implement a sector rotation strategy during the 6.5-year time period. You could learn more about our data-driven models, including the CEF, by left-clicking the Research tab up here on top, and then just simply going down and selecting the model that you want to learn a little bit more about. All of these Asbury Research models are available in the Premium Research Service. Now let's take a closer look at what we are paying the most attention to right now via our latest, the weekly wrap-up report. Tough to say, which is published weekly, as the name suggests, on the weekend based on what happened in the market the previous week. Here is the report. Let's scroll up to the top. And we can see our title is Market at a Tactical and Strategic Decision Point, but leaning higher. Our CPM model, the Correction Protection Model, which also you can get more information here from Research tab, has turned to risk on. We already mentioned that our Asbury 6 has turned to risk on, has turned to green or positive. Positive for the A6 and risk on for the CPM, which is a totally different dynamic stock and bond portfolio model. Two different models, they're both pointing the same direction. So about a week earlier, this was the weekly wrap up for the weekend preceding January the 13th. We had said that a sustained decline below 58.32 in the S&P 500 would clear the way for at least an additional 2.5% move downward to the next support level in the S&P 500, which was at 56.70. Let's jump over here and take a look at that chart. This is what I talked about a few slides earlier. This is the S&P 500. This is 58.32 right here. You can see when I move my mouse, this white horizontal line, it kind of lights up. So this was the 13th. Actually, this was the 10th. This was Friday the 10th, and we closed right on top of 58.32. This was the following Monday. This was last Monday's trade. We broke down through that level on an intraday basis, but we came right back above it, closed above the line. Really important that the market tried to push through there. It couldn't do it, and there's a lot of buying that came in. This was Tuesday of last week. Again, tried to break 58.32 in the morning, came right back and managed to close above it. So that was all the market had to see, and then CPI came out the following day. Again, a good number, not a number really that would suggest having a gap opening on Wednesday morning, but that's what happened. Largely because this 58.32 number, which we identified about a week earlier, it held. The market had 3 runs at it, failed, so it went the other way, and you had a lot of short cover, I think, that happened here. So what do we want to look at for next week? The resistance is at 60.21 to 60.50. These are minor highs that were made on Jan 6th and December the 26th. That's the level to watch on the top side. If we get through there, it's going to clear the way for more strength and possibly a retest of the high that we made on December the 6th at 6,100. Underneath the market, you've got some minor support here at 59.30, but the level to watch is 56.70. That is this trend line that originated back in October of 2023. It's an old trend line. It's been tested a bunch of times. That needs to hold for this intermediate term uptrend that we are still in to stay intact. Let's scroll down. Here's the Asbury 6, which you already spoke about. And let's look at volume. This is CVI, which is a cumulative volume index. It's different than looking at the raw volume. We think it's a lot more indicative, a lot more easy to read. indicative of the urgency to buy. So what we have here is when this particular indicator is rising above its 21-day moving average, because 21 days is a business month, and that's our tactical time period. When it's up above there, the stock market goes higher. We had a few days in October, in November, where it dipped below there, and that was this little bottom right here. So here's where we are now. We spent from December 12th to January 3rd underneath on the CVI, on this volume indicator. That gave us this move down in the S&P 500. We jumped right back above there on January the 14th, which was Tuesday. So this is Tuesday through Friday of last week, and that gave us this rally. CVI, or cumulative volume, must keep expanding in order to keep this rally alive. Next thing we're going to look at is volatility via the VIX. When the VIX is rising, it indicates the market is becoming more fearful. Note that from December 17th to January 14th, the VIX was above its 21-day moving average. That gave us this move down here in the S&P 500. This is the corresponding chart of the S&P. As of the end of last week, from January 15th on, the VIX calmed down. There was less fear in the marketplace, and that helped to facilitate the strong rally that we had in the second half of last week. This next chart, though, is the one that means the most to me. The VIX is very fast twitch. So is CVI. This particular relationship between stocks and bonds, to me, is much more important and is telling you the character of the market. On September the 18th, SPY started outperforming AGG, which is the aggregate bond index ETF. When stocks outperform bonds, it is historically in a bull market for stocks. And you can see from September 18th, which is right here, we've had a nice move higher. This 63-day moving average, why are we using a 63? Because this is a strategic metric for us. We want to see this strategic metric, which is indicative, which is more of an indication, I should say, of the quarterly trend, quarterly or larger trend. This trend's been being tested since the end of last year, very end of last year. You can see it tested on DC31, again on January the 10th. What happens on this particular relative performance chart is going to be germane and possibly a leading indication of where the next strategic trend is going to be in the stock market. As long as we hold here, and you can see the rally we had at the end of last week, it helped the relative performance between SPY and AG get a little bit better, get us off of that line. As long as we stay on the right side of this trend, we're going to see more higher prices over the next 1 to several months. Should this trend die, though, should this roll over and AG starts outperforming SPY, as it did here between August 1st and 14th, we're going to get a move down. So these are 3 key metrics that we are looking at going into next week, and we gave you the levels to watch on the S&P. Finally, in addition to our premium research that we've been looking at here, we also have a low-cost entry-level online newsletter called Asbury Research Chart Focus. It's available on Substack. The way you get there is you visit asburyresearch.substack.com, and there's a free version there. And there's also a very inexpensive $25 a month version that will give you a lot of charts, a lot of information. We actually have a model there that we built for Substack. It's called the Sort Report. It looks at 10 different market types. There's crypto in there. There's emerging markets. There's bonds. There's gold. There's 10 different areas of investment that we rank according to 3 quantitative drivers that tells you which of those major areas there's an opportunity in. So again, there's paid version for $25 a month. There's also a free version to sign up, asburyresearch.substack.com, or you could look for the Substack link, which is underneath the video. Finally, Before I go, if you can indulge me just for another couple of minutes here, I'd like to take a minute of your time to talk about the 24th annual Polar Plunge fundraiser, which is right here, which my son and my son Jack, who's also my business partner, we're going to be participating in again this upcoming Saturday, January 25th. This will be our second year. Here's some photos from us last year. We'll be jumping into the probably very icy waters of Lake Michigan for 4 Chicago families, trying to raise money for 4 Chicago families that were chosen by the Chicago Polar Bear Club because they really need help. These are real people. This doesn't go to a foundation somewhere. This goes directly to 4 families that were chosen by the Chicago Polar Bears that may have had a parent die, and there's 3 or 4 kids in the house, and they need some help so they can stay in their house. There's another one, I think, this year where somebody was in an auto accident and they lost the use of their legs, so they need a ramp so they can get up to so they can get into their house and out of their house. These are families, usually not a lot of money, just people that got blindsided by some horrible event, and the leadership of the Polar Bears finds these families, and that's where the money goes. So if you're interested in helping us to help these people, you could either Google Asbury Research Arctic Aid, which is right here. This is us. Or you could contact us directly through the contact tab at asburyresearch.com, and we will send you a link. Thanks for listening to that. So that wraps up Asbury Research's Following the Money podcast for this week. Our next Following the Money is tentatively scheduled for Sunday, February 2nd, 2 weeks from right now, today. For questions or more info on any of the research models or model portfolios we talked about today, again, just the easiest way to get us is go to the contact tab at asburyresearch.com. And have a great Sunday, and please don't forget to like and subscribe. We'll see you in 2 weeks.